again, a pleasant good afternoon to everyone. So today, let's start first by answering the question who Philequity Management is. So first of all, Philequity Management, we started way back in 1994. So we're actually one of the pioneers in terms of mutual fund here in the Philippines. So we're over 28 years of experience already in the market. So as of current, we have a total of 7 funds. So 2 of them are actually a bond market and 5 of them is invested purely into equity market. So as of current, we do have a total of AUM, 35 billion, and we do have around 66,000 investors and still counting. Now, the next question is that, who are the dedicated fund manager behind Philequity? All right, so let's start first with our Chief Investment Officer, none other than Mr. Wilson C. Okay, he's considered also the Warren Buffett of the Philippines. He's the co-founder and CIO of Philequity with over 45 years of experience. So he is the fund manager for some of our equity funds. And here with me today is also Mr. Miguel Agarao, which is also the fund manager in some of our equity funds with over 10 years of experience in the market. Okay, for the bond market, we do have a different fund manager. So that's Mr. Timothy C, which is also the president of Vantage Financial Corp and a fund manager for our 2 bonds. So for Philequity, we do have 2 bonds. So first is we have the peso, then we also have the dollar-denominated bond. And last but not the least will be Mr. Jerome Gonzalez, which is the research head of Philequity Management with over 20 plus years of experience also in the industry. Okay, so these are some awards that we have from 1994 up to the present. And some of you might question, why choose Philequity and not other mutual funds? So these are some of the reasons behind. So first of all, we're the only mutual fund in the country with the same fund manager since inception of the 1994. So with that, since we do have the same fund manager, you can expect that we have the same results year after year. And they have extensive experience of senior management. So this around 40 plus years of experience in the industry. Then our fund managers are also invested. So this is the big difference that we have with other mutual funds because our fund managers are also invested to the fund itself. So they have the majority stake in the company. So they make sure that they have good rates because their money is also at stake. And even though all our funds are locally traded, they still have a global outlook. Okay, so these are the funds of Philequity. So again, we do have 2 bond fund, 1 peso, and we'll have dollar-denominated bond fund. And we have 5 equity funds. So if you will notice, we do have 2 index funds. So just to discuss briefly our 2 index funds. First is we have the Philequity PSE Index Fund. This fund mirrors the PSEI, the top 30 large companies in the Philippines, while the MSCI Philippines Index Fund is also an index tracking fund that mirrors the MXPH. This is the benchmark provided by MSCI to measure the performance of the Philippine economy or the Philippines globally. So the distinct about these 2 index funds is that even though these are index tracking fund, they still have a fund manager who actively trades for this fund. But this afternoon, we will be focusing on our top 3 funds. So namely, we do have the Dividend Yield Fund, we have the Philequity Fund, and of course, we do have our Philequity Alpha 1 Fund. Okay, so let's start first with Philequity Dividend Yield Fund. So from the term itself, dividend, this fund focuses on dividend-paying companies. So these are actively traded every day by our fund manager. This is over 40 plus companies. So who are the companies invested to this fund? So you can see here our top 10 companies. We do have a PLDT, we have Meralco, we have Globe, Nickel, SM, and so on and so forth. So even though that market is down or if market is at correction, this will continuously gives out dividends. So this is our resilient and also defensive fund. So just to give you the dividends will not be reinvested or paid out to the investor, but rather reinvested to the fund itself. So this is as of July 29. You can also have our fund fact sheet, which we upload in our website on a monthly basis. So you can see here that the return since inception of 2014 up to the present, it's now around 25.41%. Now, if you would ask what's the return on an average or annual, so here, average annual return is around 2.71%. Now, in order for us to appreciate it more, let's put it in graph. Okay, so way back in 2014, what if you put your 100,000, or way back 2014, as of July 29th, now it's around 125,411. Okay, so next fund that we have is our Philequity Alpha 1 fund. So this fund is our aggressive fund. So the fund aims to produce superior returns over long term. So our fund manager specially curated the companies or the stocks to buy for this fund, which have strong growth potentials. So who are the companies here in Philequity Alpha 1? So you can see here as well in our top 10 holdings, we have Nickel Asia. We also have PLDT, SM Prime, BDO, Ayala Land, and so on and so forth. So this is as of July 29. It's actually below par, but you can see here as well, it's a bit negative as of July 29, around 0.50 since launch. This was actually launched way back 2019. So December of 2019, pre-pandemic. And the return is actually around 0.19%. Now, this is what we call paper loss. So if you don't redeem it yet, so these are just paper loss. But eventually, we know that market will recover. So if you have your 100,000, it's a bit lost as around 99,500. Okay, and our favorite fund. Okay, so I think most of you are invested also into this fund. Philequity Fund is our flagship fund. The main purpose of this fund is to outperform the PSEI, its benchmark, which is composed of, again, the top 30 large companies in the Philippines. So this is actively traded by our fund manager with over 50 stocks. So who are the companies for this fund? So again, you can see here the top 10 holdings. We do have SM, we have BDO, we have ICT, BPI, and so on and so forth. So ito yung fund natin that started way back in 1994. So we started this fund at 1 peso price NAV. Now it's ranging around 31 to 32 pesos already. Now for the return, how is the return of this fund, PEFI? So since inception from 94 up to the present, it gives you around 2,905% gain. On an average, it will give you around 12.92% per annum. So again, in order for us to appreciate it better, let's look at in a graph format. So if you have your 100,000 way back in 1994, now it's around 3 million already. So imagine that it also includes all the downfall and bear markets from 94 up to the present. And you haven't even added on this one, but it still gives you a positive return of 3 million. Okay, so over the past 28 years, we did outperform the PSEI 22 times already. And just to give you some of the markets when we're experiencing when the market is down or bear market, because if it's a bull market, everyone is a winner. Everyone can just outperform the PSEI. But how does our fund perform during the bear market or when the market is down? So let's start first. Year 1997, Asian financial crisis. So our economy is down by negative 41%. While our fund, Philequity Fund, this is also known as PEFI, it's down by negative 5.2%. Then following that is we have the year 2000 ERAP impeachment trial. And aside from that is we have, if you would still remember, the Y2K bubble or the love virus. And we also have the ASG hostage takings and MILF insurgencies. So the economy is down by negative 30.3, but look at our fund. Even though that the market is down, Philequity Fund still gives around 6.8%. So meaning your capital is still preserved plus a positive gain of 6.8%. Then following that year is the 2001, if you would still remember, the 9/11 terrorist attack. And aside from that is we have the Estrada impeachment. So economy is down by negative 21.8%, but our fund still gives you again a positive return of 2.9%. So again, your capital is preserved plus a positive gain even though the market is down. And we have our 2008 US housing bubble. So here the economy is down by negative 48.3, and our fund is also down, but it's just down by negative 40.7. And last but not the least, of course, our recent COVID-19 pandemic, but this still continues because we're still under the pandemic. The PSEI, this is as of February of this year, gives out around 32%, while our fund gives out around 1.62% gain. So these are some of the years that even though that market is down, we're still outperforming the PSEI. Okay, so these are the summary of our funds. So for all our peso-denominated funds, the initial investment is just 1,000 pesos. Now for the dollar, initial investment is just $500. And for the additional investment, the minimum additional investment for our peso-denominated bonds, for peso-denominated funds is 500 pesos. And for our dollar, it's just $100. Now for the exit fee, this is across all our funds. Our holding period is just 30 days, is just 90 days or 3 months. So if you redeem less than the holding period of 90 days, that's the time that you have a 1% charge. Okay, so in summary, who are the top 3 Philequity funds? So again, let's discuss Philequity Dividend Yield Fund. So this is our resilient and defensive fund. Then we also have Philequity Alpha 1 Fund. This is our aggressive fund. And last but not the least, of course, we do have Philequity Fund, which is our flagship. This is somewhere in between Philequity Dividend Yield Fund and Philequity Alpha 1 Fund. Okay, and some words of wisdom from our fund manager. Okay, and that ends my presentation. Thank you and enjoy the rest of the program.
The problem with presenting in the past 2 years is my presentation, say 1 month ago, can be very different from my presentation 1 month after, especially during the start of COVID when a lot of things change. But for this particular cycle, the title of my presentation is the R word. And R could stand for many things, but typically, I would start my presentation with the different factors that will move the stock market. Now, in 2020 and 2021, every presentation was about COVID. And you can imagine by early 2021, people were tired of hearing about COVID, but it still mattered then. What I want to say is that for this particular presentation, we're no longer going to talk about COVID. In my presentation in January this year, that was my first presentation where I said, COVID will no longer be a major driver for the stock market moving forward. It may drive our lifestyle, our behavior, and well, I guess if you live in China where they live in zero COVID, well, then it'll affect you there. But for most parts of the world, including the Philippines, it will no longer affect the market. If you noticed, from 2020 up till January 2022, the corrections caused by COVID got shallower and shorter in duration. So you had the 20+% correction lasting months, and then later it became 15, lasting only 6 weeks, so on and so forth, until the January correction was just like 4%, lasting like less than 2 weeks. So after that, I don't think COVID is going to matter anymore as far as the stock market is concerned. Now, the bad news is a lot of other things will now matter to the stock market. So R can stand for inflation rate, R can stand for interest rates, R can also stand for recession risk. So these are the things I want to focus on today. I'm going to show you a little bit of the others also. But I just want to focus on these 4 main things as these are what will drive the market moving forward. So a lot of people have been asking, are we going to have a recession? Now, the way to answer that, there are many ways to answer it, but I want to show you economic data. Now, what a recession means is growth turns negative. It means the economy contracts from, say, the previous year. And if you look at our first quarter growth, it's positive 8%, not negative. Although, well, inflation's not yet there, so I expect that to go down in 2Q, 3Q, 4Q. But still, GDP could still end up at 6% for 2022. Even if it goes down to 5, that's still positive again, not a recession. OFW remittances already went back to pre-pandemic levels last year. They did slow down this year, though, only up to 1.5%. Now, even though the economy is already back to pre-COVID levels, even though remittances are back to pre-COVID levels, even though some companies are actually above pre-COVID earnings already, I want to show you that the recovery has been quite uneven. Yeah, so government obviously did this, recovered faster. BPOs also did. Education, that's getting back on its feet. Finance, that was largely unaffected anyway. But if you look at this right-hand side of the chart, so this is data from ADB, you see the sectors which employ a significant amount of people by headcount. These are the ones which are not yet back to pre-COVID levels. In fact, they're down between 30 to 40% of what they were pre-COVID. So like your restaurants, tourism, public transportation. So yeah, these are the ones which, are still very, very far from where they used to be. Arguably, tourism is recovering, and so are the restaurant sector. However, just note that there have been permanent closures in both industries, which brings us to inflation. So this is what's dragging down our growth. And I want to highlight a number of things here. Number one, this is your headline. And look at how we stay and after the trade war, it started to move up. And why did that happen? Because food prices were practically flat and then they moved up significantly. Depending on what you buy, your inflation could be like 30-40% if you're buying, say, a lot of veggies or for some time chicken and fish. There you go. The other thing I want to direct you to is, hold on. Here we're back. Okay, the other thing I want to direct you to is this part. So you see, for transportation, inflation used to be below 10% and now it's moved up to about 17%. It's probably close to 20%. This includes the 2 peso fare hike already for public utility vehicles, but note that I think the PUVs are asking for another 2 pesos on top of that. Taxis are asking for a higher flag down rate, so on and so forth. So this one can go above 20% by year end if all those fare hikes are actually approved. So that's what's really driving your inflation, food and transportation. Now, food and transportation both need oil because you've got to move the food, right, from farm to market to us. Transportation, you need gasoline, unless you're like riding on a horse or something. And if you look at how much oil prices have gone up, they're down about 20% from where they used to be, but they're still up like 40% from the lows you saw in 2021, which is again very significant, which is why you see gasoline prices still up very much this year, even though you've probably saw some rollbacks in the past few weeks, except this week. Now this, depending on who you are, this is either really good news or really bad news. If there are OFWs listening now, this is wonderful news for you. If you're here though and not benefiting from OFW remittances or if you import, this is very painful. This is a chart of the Philippine peso. It has it broke its record low of 56.50 today. It hit an intraday low of 56.90. I don't know where it closed, maybe 56.80, 83 before I started this presentation. So the peso has weakened significantly. And because the Philippines is a net importer of goods, this can actually feed into your inflation figure. And I just want to show you a 20-year chart. You'll see here, ERAP political crisis, fiscal crisis, hello Garci. All these previous lows of the peso, these were all broken today. This is now the record weakest point for the peso. And another reason behind that is we've started importing more. I don't know if you noticed, but in 2020, when everything was on lockdown, you take a look here, the peso was pretty strong, right? Well, that's because no one was importing anything, because no one was buying anything except groceries, right? But as the economy reopened and we started buying more, going out more, the import bill went up, and we now have a record trade deficit in May, and I think June's also another record again. Now, part of this is dollar strength. Part of it, though, is also what I showed you, country-specific factors which cause the peso to weaken, like a record trade deficit. And once upon a time, maybe in April this year, the peso was maybe one of the better performing currencies. But as you know, we started importing more and policies changed, the peso is now the third worst performing currency in Asia, down more than 10% year to date. For OFWs, that means what you send back will give your families 10% more in peso terms, or you can send back 10% less and they'll get the same amount. Now, you're all aware of this. Our debt level is at 13 trillion. It's gone up 50+% because of COVID. This was inherited by the new government, so that's going to be a problem for them. But just to summarize that part, we have exceeded pre-COVID levels of GDP. However, scars remain, such as mounting debt, permanent business closures, job losses, depleted household savings. And unfortunately, the new factor which is affecting our market is the sudden and sharp peso depreciation. So without going into details, what I can tell you is statistically, there is no situation where the peso weakens significantly and the market goes up. So I've looked at 30 years of data. There's none. So are we going to have a recession? Short answer, for the Philippines, extremely unlikely, okay? But I want to highlight that Europe is very likely in a recession now. China is having a sharp slowdown. Now, let's see if the US enters a recession. Now, if those areas, those regions, those countries have a deep or prolonged recession, I doubt the Philippines will have a recession. However, we are going to have a slowdown. And that slowdown may be bad enough that it will feel like a recession, even though technically it is not a recession. So, short answer, nope, we're not going to have a recession. But if the world enters a recession, our slowdown will be quite painful. Which brings us to rising interest rates. So, because your inflation here is like 6+%, it's already so painful. I want to show you the US. Inflation in the US is 9%. Inflation in Europe is 10%. Inflation in the UK is like maybe 12%, probably going to hit close to 20% by year end. So the inflation problem is actually much worse abroad than here. Okay, I actually have a friend who lives in Germany, and we were comparing the per kilowatt hour or per megawatt hour charging for the electricity bill. And I can tell you, on his October, kasi in Europe, it's a contracted renewal. It's not a per month thing. So when he renews his contract on October, his electricity rate will be about 6 times higher than the Philippine per kilowatt hour rate. So that's how much more expensive it is in Europe. So I'm not saying 6%. I'm saying if you pay 10 pesos per kilowatt hour here, it's paying like 60 pesos equivalent in Germany. It's that bad. It's that bad here. Fortunately, though, oil prices have fallen. That's why diesel's not close to 100 anymore. It's like 70 plus, so that's great. I just feel bad for people like me who bought diesel cars because it was cheaper than gasoline. Who would have thought this would happen? Now, if you read the newspapers, many economists have said that inflation has not yet peaked. Okay, here at Philequity, we are making the assertion that inflation peaks in the third quarter. The only question is it July or August? And as I showed you here, it seems oil has peaked. But how about other agricultural commodities? I want to show you sugar. Diba, we have a sugar crisis, so really high sugar prices here. What I'm showing you here are international sugar prices, and they haven't moved up. They're just moving sideways. So the high sugar prices you see in the Philippines are really a Philippine-only problem. I think you know what I mean when I say that, but yeah, I just don't want to say it out loud. But here's the chart of international sugar prices, no spike. If you look at corn, it's back to pre-war levels already. If you look at soybean, it's down 20% from its high. You look at wheat, this is used a lot for instant noodles and cookies. It's down 40% from its high. It's back to pre-war prices already. If you look at palm oil, both for cooking oil, cookies, and other desserts, it's down 55% from its peak. It's below the levels when Indonesia had the short-term ban on exports. It's below the peak after the Ukraine war. It's actually below its level that it started the year. So, this is very good for inflation. So just by looking at the charts, even oil, it looks like inflation has peaked. But, the numbers you see kasi on the newspaper, CPI, inflation, these have a lag time of about 2 months. So you're going to see the impact of this closer to the Christmas season, which is great. So at least when we do our Christmas shopping, prices will be lower, right? So this is what gives us confidence to say that inflation has peaked already, or if it hasn't, it peaks this month. Now, there was a debate last year between economists where economists and Fed central bankers, including the US Fed, said that inflation would be transitory or temporary. Some people said it would be persistent. Now, clearly from what I showed you, inflation was persistent. So central banks, including the Fed, those who got it wrong, had to act accordingly. So the Fed raised interest rates aggressively. It's now at 2.5%. It's the largest rate hike since 1994. 2.5% may look low, but US interest rates came from 0.25%. So you can imagine in terms of when mortgages, how much interest they pay per month, that has probably gone up maybe 40-50% in the past 9 months. So it's tough. Interest rates have gone up a lot there. So I just want to show you how it looks like. Interest rates are here already. The question is, how much higher does that go? And based on Powell's speech last Friday, that goes up a lot higher. If you look at Philippine bond yields, these have risen dramatically as well. So we have some bond funds. If you want like a safe income, low return income generating portfolio, there's no harm buying bonds now with yields this high. Which brings us to our interest rates is at 3.75%. Is 4% enough? Should it be 4.5% with the peso weakening so much? Should BSP Governor Medalla actually raise rates a lot higher than his previous forecast? So let's see, because they don't want the peso to be too weak, and raising interest rates is one way to arrest that. Now, I'm going to show you a couple of charts later, and these charts answer the question on, are rising interest rates bad for equities? And when I first presented this last year, I got a lot of flack for it because people did not like what I said. But as each month goes by and I showed the same chart, just updating it, people realized that, statistics were correct. And I'm not trying to guess here. What I did was I looked at 70 years of data for the US and 30 years of data for the Philippines. I wish I had more data for the Philippines, but the stock market was like dead prior to the 90s. So, 30 years basically is all I had. So I used 70 years for the US and 30 years for the Philippines. And I'll show you what it tells me. In orange is the US, in green is the US stock market, the S&P 500. In green are interest rates. And without going into the details, I'll tell you what conclusion number one is. Over the past 70 years of data, I'm only showing about 40 here, but over the past 70 years of data, there is no situation in an early rate hike cycle where the market goes up. None. Zero. And people were thinking, this year, this time, it's different. This time wasn't different. Batting average 100%. You see, that's from when I first presented this. Look at the S&P 500. Look at it now. And now I include in red the Philippines over the past 30 years. And you'll see it was just modeled by stuff like Asian financial crisis, our own political crisis. But by and large, when interest rates are going up initially, markets always fall. Now, that's conclusion one. Pero nangyari na yun, tapos na yun. The market already fell. Which brings me to conclusion number two. You see markets moving up here already, moving up, moving up. If the economy can grow despite rising interest rates, despite tighter monetary policy, a new bull market will begin again. And that's what we should watch out for. When will that bull market start? Or possibly, has it actually started already? So the pushback I get is, the US actually hasn't entered the recession. Well, yes, and the chance of a recession, according to these firms, is anywhere between 30 to 50% over the next 12 months. But I want to highlight the thing with the market, it prices in news 12 months ahead of time. So this move here, I think this partially priced in a recession already. Has it fully priced it in? If it's a deep recession, no. If it's a shallow recession, I think so. Europe, though, is in a totally different position. It is really, really very bad there. They are in a recession already, 1 quarter ahead of schedule. This survey was done actually in April to May this year. They're already sure they would have a recession in 4Q, except it happened in 3Q. So to conclude that part, rising interest rates and rising recession risk make navigating the investment landscape more difficult. But a bull market will begin again once growth resumes despite tightening monetary policy. So where does the stock market go from here? Where currently the stock market is not in good shape, but this is the opportunity. Because stocks have fallen a lot and have gone nowhere in the past 5-6 years, you are getting companies at very, very cheap valuations already. Each year it continues to get cheaper. And if you believe in the long-term trajectory of the Philippines, now is your opportunity to buy. COVID is done. Inflation has likely peaked. Yung kalaban na lang natin ngayon, weakening peso and how bad the recession abroad will be and what its impact on the Philippines is. But the two biggest bad news that's out of the way already. Okay, I will go into the details of this, but basically, if the US does not have a recession, I think we bottomed in June already. That's the lowest point for the market. We may see corrections along the way, but I don't think it's going to break that low. If we have a deep recession, though, then that's a different matter. But we're using data here also going back about 70 years. But anyway, so just to show you the Philippines, our initial target of 7.4 was reached. The market hit a bottom at 6,054 and has since gone up 12% from that low. We think that unless there is a deep or prolonged recession, this low will no longer be broken. You may correct, you may fall, but unless there's a deep recession or the peso goes to like 60 pesos or something, this level is probably not going to get broken anymore. Unfortunately, the foreign funds are still selling. So they were buying for a bit in December and February, but they're back to selling again, although not as bad as it was last year. And if the foreign funds keep selling, the question is who's buying? And the buyers are the owners of the company. So I just want to show you here, 2021 and first half 2022, owners of companies such as the Ayalas, Andrew Tan, Gokong Wei, MVP, Ricky Razon, they've bought about 31 billion worth of their stocks already in the past 1.5 years. And Ayala bought another 12 billion, so there's actually 43 billion already. And they have about 40 plus billion of war chest left to go. So because their stocks have not gone anywhere in the past 5 years, the owners recognize that their stocks are very cheap. They know that they will now start growing from here, and therefore they'll be buying at very cheap valuation. So if the owners are buying this much at current prices, it begs the question, shouldn't we be buying too? Now, we don't have to buy as much as them and we can space out our buying, but clearly the owners have decided now is the time to buy our own stock. And we look at our forecast and we see that by and large, companies are going to grow their earnings this year, which, is a good thing. We're going to see weighted average growth of 19%. So what's our fair value for the PSEI? It's 7,350 for this year. Basically, we're saying the market goes back to the highs it saw last year. And at this valuation, the market is not expensive. This is just a fair valuation. The only question is 2-3 years from now, will we have a power crisis? Hopefully not. But in the near term, if inflation has peaked, I think 7,350 is a good fair value for the market by year end. So what are the catalysts for market to go up? I've listed 5 here. One has likely already happened, which is a peak in inflation. Second is the US market bottoming and going up. We have to understand the Philippines is a peripheral market. We are much smaller than the US. So a lot of markets, not just us, we tend to follow the move of the US stock market. And so far, it looks like it has bottomed, but the US is starting to fall again after Powell's speech last Friday. Again, we do not think the low will be broken unless there's a deep recession. So if there's more of a correction, I think those dips are an opportunity to buy. But I just put this in yellow in case there is a deep recession and we're wrong about the bottom. Now, the dollar peaking then weakening should have been a catalyst, except that it went the other direction. It went higher and caused the peso to weaken. So this is working against our stock market and it's a risk, especially for companies that borrowed a lot in dollars. So you have one good thing happening, you have one bad thing happening, then you have this somewhere in the middle. So to summarize, COVID will no longer be a major driver for domestic stocks moving forward. Global stocks initially corrected because of inflation, which was stoked by the Russia-Ukraine war. As inflation peaked, though, you had central banks now raising interest rates faster than expected, which caused the second wave of the correction. And this tightening cycle, while it's a short-term negative for equities in general, it will herald the start of a new bull market if growth can continue despite rising interest rates. The next thing that's happening now is rising recession risk. And the question now is 6-12 months from now, in what form will the recession take and how long will it last? Now, and foreign funds have reduced Philippine holdings significantly. Now, some people make the argument that the market can go up without foreign funds. And I disagree with that. I think the market can stabilize without foreign funds. Just tayo-tayo lang domestics and Filipinos trading. But if you want to go to 9,000, if you want to go to new all-time highs, I really think we need the foreign funds to actually start buying Philippines. And when you saw foreign buying 3 weeks ago, 2 weeks ago, our market went up significantly. They're not buying as much now. On a year-to-date basis, it's still a sell. But you can see even a little foreign buying over 2 weeks can make our market go up 10%. Now, because the foreign funds are not buying, it's the local corporates and the owners who are buying back large amounts of their shares. And this tells us that they think their stocks are not only very cheap, but they have attractive growth prospects in the next 1, 2, 3 years. Otherwise, why would they buy their own stock? They should probably use the money for something else. But it's become so cheap and their stocks will grow that they've started buying. So what are the main risks to our forecast? Well, a Fed mistake, number one, or a potentially deep recession towards year end. Now, it's always good to be bear watching. As I said earlier, the market already fell because of all the factors I mentioned. A lot of the magnitude of the drop has already happened. So what we should be doing now is watching for the start of a new bull market. And that's where the big money is made. So with that, I end my presentation. Thank you very much.
Ang hatid nito, syempre, higher